All right. Well, good morning, good afternoon, everybody. Thank you for attending our talk today. We are going to have a hopefully engaging discussion on the tax incentives and how they are impacted by the One Big Beautiful Bill. And with that, I will start going through our slides here. So again, thank you for attending. Just a quick background about who we are and hopefully why you should listen to us. We are all of us with Leyton. Leyton is an international tax consulting firm. We are in 16, 17 different countries. Been 50,000 clients, been in business for over 25 years. Definitely a lot of clients in Europe, been in the US for many years now. We really specialize in the intersection between tax and engineering. So generally when things get a little too complicated for a CPA, that's when a company like Leyton's going to step in and help you out. So what are we going to cover today? And then we'll just do some quick introductions. I always like to tell people what we're going to tell them so they know, and then repeat what we told them, just to make sure everyone got it. So we're specifically going to talk about, a lot of you are probably here for the R&D tax credit, specifically Section 174, which we're going to get into. Employee retention credit, still around. We're still talking about it. We just want to make sure we get everyone handled and everyone's got that figured out. Then I'm going to talk you through Section 179D, which is going to be an interesting one. And then the investment tax credit. So if you're dealing with solar, this one's the one to pay attention to. And then Will is going to make us all feel better by talking about how much cost segregation is going to save you at the end here. So looking forward to that as well. So with that, I'll do some quick introductions and then we'll turn it over. So hi, everybody. My name is Mark Bacon. I am a practice lead for our energy efficiency service line, or commercial real estate services, which are 179D, 45L, cost segregation and investment tax credit. So I've been in the space for 10 years here, been an engineer for 20 years off and on. Just really looking forward to the discussion today. We've done 10,000 of these energy studies. So if you've got questions, please ask them. We've got a chat. We'll answer them as we go. We'll also have room on the end for a Q&A. Those of you who are eagle-eyed will notice that we did this same seminar about 2 weeks ago. It actually got so many questions that we're doing a repeat of a lot of this just to make sure that we can answer all of the questions that you may have as you go through. And with that, Will, I'll turn it over to you for a brief introduction.
Awesome. Thanks, Mark. Like Mark said, my name is Will Whiteman. I work on the cost segregation side, work with him on the commercial real estate team. And I've got about a decade of experience in cost engineering, with most of that coming in cost segregation specifically. So we've worked with hundreds of clients to help reallocate millions of dollars worth of tax deductions, and ultimately saving business owners and real estate developers or real estate investors millions in tax dollars. So happy to be here to help share more how this new bill can help you save more on your taxes. And I'll kick it over to the R&D guys.
Thank you, Will. Hi, everyone. My name's Devin Medrick. I'm a tax manager here at Leyton. Was at PwC for a couple years before this, but I've been at Leyton for almost six and a half years now. Probably have done over 500 R&D claims over the past 6 years. So our team is specifically focused mainly on R&D, also grants, orphan drug credits. I've specifically spent a lot of time on 174 compliance over the past couple years. So really happy to be relaying that that's no longer a thing going forward, and looking forward to getting into it. Ben?
Thanks, Devin. Hey, everyone. My name is Ben Brissett. I'm assistant team lead and senior consultant here at Leyton. Been with Leyton almost 5 years now, coming up on 5 years in about a month or so. Helping out on mainly the R&D innovation team. I helped lead the ERT team back in the day when that was up and running, and currently still serving on that team with anything that's still going on there, as well as help start the orphan drug tax credit service that we offer here. Background is in accounting. I have an undergraduate in accounting, my MBA, and I'm currently sitting for the CPA exam. So happy to be here, happy to provide you guys any information, and looking forward to chatting with you all.
Great. Well, good luck on the CPA exam, Ben. I always say that. It's always fun. So with that, I think we'll keep it running with R&D, and specifically Section 174.
Yes, sir. Thanks, Mark. So starting with a recap of what the situation has been over the past few tax years, which most people attending have probably heard at least once or aware of, but basically the Tax Cuts and Jobs Act, it was passed in 2017, but this specific element was enacted for tax year 22 through now and through 24. It was 22 and onward previous to this new bill. But it basically said research and development costs need to be capitalized and amortized over a certain period, depending on if they're US incurred, US located, or foreign based. So, most companies attending here or CPAs with their clients, it's almost all going to be US based costs, wages, supplies, etc., going into the R&D work. That basically had to be amortized over 5 years instead of being immediately deducted. So the credit is about 10% of qualified costs. You can imagine, taking not immediate deductions on that cost sum, even with the credit not being affected by this bill at all. It was really disadvantageous for companies in the short term not to take those expenses right away. Foreign-based costs were kind of even more punishable, you could say, needing to be amortized over 15 years. So no immediate deductions were allowed on research costs. This technically was regardless of whether a company was claiming the credit. And on top of all that, it wasn't just direct costs that comprised the credit, being wages, contractors, supplies, and computer leasing costs. Companies also had to look at indirect costs, quote unquote. So, thinking about like building rent, utilities, depreciation on machinery and equipment used in R&D. Not just W-2 Box 1 employment payments, but 401k matches, other benefits. All this stuff had to be looked at and capitalized at least in portion in conjunction with the R&D activity occurring. So again, really disadvantageous, and luckily this is changing going forward. So what are the effects of the actual new bill, the One Big Beautiful Bill? Basically says most companies don't need to worry about any of this capitalization requirement going forward. Excuse me, for tax year 25 and onward. Foreign-based research costs still need to be capitalized and amortized over 15 years. But for most companies performing R&D, no foreign-based costs. You can go back to claiming the credit and taking immediate deductions in full on the return. So that's for tax year 25 and onward. Couple other things. There is some, excuse me, I'm a little sick, so a little stuffy. There is some retroactive relief in a couple of regards. So one is if a company did capitalize in 22 through 24, they can accelerate all remaining amortization either on 25's return or on 25 and 26's return evenly. So say you capitalize in 2024, you're going to have 90% remaining capitalized costs to amortize, which is the same thing as depreciating. Essentially, it's taking expenses over time. You can now accelerate that remaining 90% that was capitalized on 25's return, or you could do 50-50, like I said. So you can catch that up for tax years going forward, and that's eligible for all companies, regardless of size. The other thing is actual retroactive relief on amended returns. So if you meet certain criteria, which is that gross receipts of less than 31 million, you're deemed as an eligible small business for this. And if you capitalized, and we think even if you didn't capitalize at first, which we'll detail a little bit more, but you can amend to take those deductions, essentially uncapitalized, while claiming the credit on tax year 22 through 24. So especially if you did capitalize, you will have paid quite a bit of tax, and you can amend those returns to basically get that tax back that you, in hindsight, overpaid. And the main thing on that is that there's a 1-year deadline to do so, and you need to meet that gross receipts threshold, you need to be under that. We'll get into some more detail on this next slide with Ben.
Perfect. Thanks, Devin. Kind of outlining what Devin just mentioned there, there's really 3 separate options here for the look back the prior 3 years for 2022 through 2024. One of the options, the amended returns, is only available for any small businesses. And as Devin mentioned, that's somebody that averaged less than $31 million in gross receipts during 2022 through 2024. If you meet that criteria, you're able to choose any of these 3 options. First and foremost, you can go back and retroactively amend those returns. and claim the full deductions in those years. Pro on that, you get to generate some cash refund. However, on the downside, there's of course that additional admin burden going back, restating those tax returns. If you're an S corp or partnership, for instance, you have to also do any flow throughs to the shareholders or partners. So there is some extra work there, but you do get that cash refund if up to the amount you paid in taxes in those years. Options 2 and 3 here are available to all companies, regardless of size, and that's just accelerating your depreciation, or accelerating your amortization moving forward. What this means is in 2025 or evenly over 2025 and 2026, you can just take the rest of those capitalized expenses and accelerate the amortization in either 25 or 2026 as well. And now with this, it's a little bit easier. You don't have to go back and amend any returns. You can just do a catch up moving forward, help offset any tax liabilities you have in the upcoming years. On the downside, though, it might create an NOL carry forward position where you have a lot more deductions in the current year than actually your tax benefit. So there always is a pros and cons, analysis that we should be doing here to see what is most beneficial to you guys, and it is going to differ from client to client or company to company. But these are the 3 options. Again, the amended returns look back is only available to any of those small businesses that is under $31 million in average annual gross receipts. Everyone else can also just do that accelerated amortization moving forward for 25 and or 2026. What this means, moving forward, as Devin said, starting in 2025, it gets rid of all these capitalization and amortization requirements. This means you can just fully expense your R&D costs in the year in which they were incurred. In turn, this strengthens the R&D tax credit because not only can you fully deduct those expenses, but you also get that same dollar for dollar tax offset against your tax liability. There still is what's called a 280C election statement or a 280C election, which can either be done right on the R&D tax credit form or by filing an election statement. But this is essentially a way to tax the credit, so to speak. What this means is you have to either increase, you have to either reduce your deductions by the amount of the credit or reduce the credit that you're claiming right on that form 6765. But it does, just allow for that full deduction in the year and getting the credit on top of that. It really just mimics the pre-2022 days. So if you previously filed or familiar with it back in 2021 and previous, then it just goes back to those ways of being able to get both that deduction and the credit on top of it. And lastly, it just kind of simplifies tax planning moving forward. A lot of companies have had to kind of weigh the pros and cons of investing in the US or investing in R&D because of how that might impact your cash flow or your taxes. So now, you don't really have to make that decision in the same sense. You're able to continue your deductions as you have all along, and then get the benefit of the credit on top of it. So it's really just reverting back to, incentivizing U.S. innovation, domestic expenditures. Like Devin mentioned, there is the requirement still on any foreign-based expenses. But when it comes to anything domestically, moving forward, it's definitely a good sign for all things innovation.
So Ben, I don't think we have this the last recap slide. So I just want to recap a couple of the points, make it kind of as clear as possible. What the certainties of this bill are is that 2025 and onward, all companies can just expense their R&D, claim the credit like it used to be, like it should be. If you capitalized as a company and you meet that gross receipts threshold, you can either amend or you can accelerate all remaining amortization next year. The only piece of uncertainty, like I alluded to, is if you didn't capitalize as a company in 22 through 24, the only thing the bill says, black and white, is that retroactive relief can be done on amended returns if you meet that gross receipts threshold. So the way we're reading it, the way that the industry seems to be reading it, is that you didn't need to initially capitalize to take this retroactive relief. So just to make that clear, like a lot of companies kind of dropped off. They said, no, we don't do R&D anymore because of this capitalization requirement. It's something we definitely recommend you confer with your CPAs on, and we're happy to be part of those conversations. But it reads as if all companies, as long as that small business criteria is met, can now amend to claim the credit. And that would be even for 24 if 24 has not been filed yet. Needs to be done on an amendment.
Sounds good. All right. Thanks for that info, gentlemen. We're going to switch over to the employee retention credits. Just before we do so, again, just to reiterate, please ask questions as you go. We've moved off R&D, but we get Devin and Ben will be monitoring the chat. So if you get questions, ask them. Otherwise, feel free to hold them to the end. And now let's talk ERC.
Perfect. I'll go over employee retention credit a little bit. There have been some changes that the One Big Beautiful Bill brought. As many of you are aware, the ERC isn't still around as far as being able to claim the credit, but they still did make some changes retroactively to some previously claimed refunds or credits. Most notably, they did a retroactive claim cutoff. And what this means is they just established a cutoff date of January 31st, 2024 for claiming the ERC refund for the third and fourth quarter of 2021. Essentially, if you filed for the credit, if you filed for the third and or fourth quarters of 2021 after January 31st, 2024, and it hasn't been paid out, it's likely that it's going to be disallowed moving forward. If you've already received your refund or you claimed the refund prior to this January 31st deadline, then there's going to be no impact on you. Those claims are still being processed. The refunds are still going to be issued. We do just see a lot of backlog, and it's certainly taking extended period of time in order to get that refund. But this only impacts you if you claimed the third and or fourth quarter of 2021 after January 31st, 2024. So it does kind of create this, interesting, unfortunate situation where two taxpayers who might have claimed, the credit on both were entitled to claim the credit, and just, one claimed it in January and one claimed it in February of 2024, and they just haven't been paid out yet. Unfortunately, even though you at the time you filed when it was correctly to do so, now you might have missed out on that because the IRS has just been delayed and you haven't received that refund. So it is certainly interesting to see how they were able to go back and retroactively do this, but that is the update on the ERC side. They also kind of extended the statutes of limitations as far as doing a review or an audit of your ERC claim. Likewise, this is only for the third and fourth quarters of 2021. So anything previous or any 2020 or Q1 or Q2 2021 claims don't fall underneath the same statute of limitations. But for Q3 and Q4 of 2021, they extended that. Rather than doing a 3-year period, it's now a 6-year period in order to do some type of examination. To note, the period begins at the latest of either the original due date or the date that the claim for refund was filed. So if you filed it, let's say in January of 2024, they could have up until January of 2030 and actually to do a review or a refund or a review or examination of that claim for refund. Again, that's nothing to do with anything prior to Q3 2021. That's still just underneath that 3-year statute of limitation for any type of examination. And lastly, these last 2 points I'll go through kind of quickly. The IRS really just increased their scrutiny on ERC promoters and penalties related to erroneous claims. This mainly is to catch those, so-called ERC pop-up shops or bad apples, so to speak. They really just enhance the penalties. There's tougher penalties and compliance standards. It kind of includes the level of the assessable penalty. They added a penalty for failure to comply with different due diligence standards, and really looped in these ERC promoters or ERC companies as well. So, if somebody was pushing you to claim the credit, if somebody helped you claim that erroneously, it's not just the company or the entity that could be held liable. It's also the companies that were working with them in promoting this as well. So, just a couple updates there. Hopefully no one falls into that category. But if there were any erroneous claims, if there were any of you that worked with these so-called ERC promoters, there are some additional penalties that you could see enacted, if the IRS were to pull some type of examination and decide that it was erroneous or fraudulent in any sense. That's really it on the ERC side. Like I said, it's not still open for claiming the credit. You can't go back anymore now that the window has elapsed. So we have been seeing claims still being paid out quite frequently, and that has been an uptick over the past 4 to 5 months. So hopefully, if you have any claims out there that are still waiting on refund, we'll be seeing them come across in the very near future. But unfortunately, if you did miss that January 31st deadline back in 2024 for either Q3 or Q4, you're likely going to receive a disallowance notice in the mail shortly.
All right, thanks for that info, Ben. I think as Ben was saying, there are a number of bad apples out there. I think he's saying he's a good apple. So if you get any questions, feel free to reach out to Ben. He can help you with that. We do occasionally get people come to us and say, hey, we did this with another company. What should we be doing? So it's a lot of people kind of fell victim to what seemed like quick and easy money at the time, but we never ran that way. So happy to see that we're kind of above the law on this one. And I think with that, it is my turn to speak for a little bit. So I'm going to talk you through section 179D, section 45L, and ITC. So basically this is 179D is for commercial building owners, 45L is for residential developers, and ITC is for anyone who's doing basically energy technology. So think wind, thermal energy, solar. These are kind of the main things within investment tax credits. So I guess I'll preface this by saying most of what I'm going to say is not really great news for me because I've been doing a lot of these tax incentives for 10 years now. The one big beautiful bill definitely did damage to a lot of the sustainability marketplace. Specifically 179D, it's been around since 2006, really, really well used, but there is a key word in there that doesn't go over terribly well with a lot of changes, and it's energy efficient. So 179D was not actually part of the initial thoughts of termination. We actually thought it was going to survive. So when the Senate made their final recommendation, it did sunset 179D. Now, what does that mean for you? 179D, the way it works is it is a per square footage tax deduction for someone who owns or designs buildings. So if any of you are an architecture or engineering firm, you should be looking at 179D if you're not already doing so. If you're doing work for government entities or any other nonprofit, since basically nonprofit government entity, anyone like that, they don't pay taxes, so they can't take a tax break. They can award that to you. So I would encourage any of you out there, architects, engineers, or doing building design in any way, follow up with me later because this is being sunset. So get your money now before it's gone, basically. It also applies for building owners. And as I said before, it works on a per square footage basis. This year, it's worth $5.81 a square foot. So if you own a 100,000 square foot building, you're eligible for a $580,000 tax deduction when you place that in service. So it's been a very powerful incentive. It's specifically focused in on trying to make us more efficient with HVAC, lighting, and building envelope. So those of you who work in buildings will realize pretty quickly that having a tight envelope, being, fairly airtight makes a big difference for you. LEDs tend to be a pretty frequent upgrade, but HVAC, you got to be paying attention to that. So the government wanted to incentivize people to do that. Now, it is going to be terminated for any project that begins construction. So it ends on June 30th, 2026. So if your project is not placed in service, is not start construction before July 1st of next year, you will not be eligible for 179D. So we're getting a lot of people rushing in saying, okay, I need to get construction running. Now, how do you define construction start date? So it's safe harbor rules. Some of you, if you're talking to your CPA, will be familiar with safe harbor rules if it's existed in several places. Specifically, a lot of safe harbor rules around things like there was an issue back in the day where people would, in order to get a tax credit for a wind turbine, they would put in the foundation and then just leave it there for 10 years. So they started establishing things around physical work and safe harbor. So you need to incur 5% of your costs, or the physical work test is you have to have substantial construction. Now, currently, most people are interpreting substantial construction as basically if you have, say, concrete poured, like you've got the footings, you've got the plumbing, that kind of thing in place, you're meeting substantial construction. So if you're thinking about building a building and you're going to need tax deductions, make sure you're putting down some concrete before July 1st of next year. And we can help you kind of walk through that if you've got any questions. But it's still good. It can be retroactively claimed as well. So you can always go back, talk to your CPA and say, I need to file a 3115 to change my accounting method to catch up on depreciation that I was due. Now, my biggest concern with that, to be transparent with everyone here, is the way a lot of tax software works is they will expire forms after this doesn't exist. So you may go try to retroactively claim 179D for a 2024 build, and it might be in 2027 you're trying to do it because you've got the tax appetite then, and your tax software won't let you do it. It'll say Form 7205 is no longer valid. So any of you have been on the fence about, okay, should I do 179D now or later? I would really recommend you look at it now, because you're not going to want to have to fight your CPA, your tax software, and your shareholders to take a tax deduction. Anything you can do to eliminate some of those concerns, I would recommend it. So that's 179D. Basically, the way we think about it is you probably get about 2 years left on 179D. So you get started construction before July of 26, which average construction life cycle is 12 months. Some projects I work on have been being built for 4 years. So realistically, we've got a few years left of 179D. Not so much the case with 45L for residential developers. There's one key reason there. It's terminating on the same date. 45L was always extended through to 2032. 179D was actually permanent until they removed it with the One Big Beautiful Bill. But basically what they did with the One Big Beautiful Bill is they just pulled it in from 2032 back to 2026. The challenge here is you have to have sold the building, or there has to be somebody living there by July 1st of 2026. So you don't have that window of starting construction and then renting it out later or selling it later to be able to claim the credit. You have to basically have that unit occupied by July 1st of next year. So any of you out there who are thinking about building an apartment building right now, unless you can build it and lease it out by July 1st, it's probably a little late. So projects that are already in the works, you're probably good on. The big question is, after 2023, you have to be building to Energy Star. So you would need to have an Energy Star contractor. That's a service that we provide at Leyton. So if you are thinking of building and you want to be compliant in order to get this tax credit, it's worth up to $5,000 per dwelling unit. Generally, you're going to get about $2,500 per dwelling unit. So it's a pretty substantial tax credit, leveraged pretty well. So I would recommend you do it. Energy Star is the complication. Before 2023, you didn't have to worry about Energy Star. It's a fairly basic HERS rating. You can go back and retroactively claim those. As I said before, I would recommend you do that now. Even if you're looking at NOLs, I would recommend you pursue 45L now, just so that you're able to leverage this while you can. Okay, investment tax credits. This one's going to be a little interesting. There's a lot going on here. I'm not going to read this. I will say, full caveat here, and you can use this to maybe not listen to me for the next few minutes, but we did do a 30-minute webinar just on investment tax credit. If you go to our YouTube page or to our website, you can find it. Investment tax credit is far less linear, because an investment tax credit is based on the technology that you install in order to make a building run more efficiently. So, and then on top of that, there are bonus adders. So the way to look at ITC is each type of technology you install is almost like its own service line. So there are experts in investment tax credits for geothermal heat pumps. There are experts in investment tax credits for solar buildings versus solar farms. Those can go into production tax credit. There are entire teams that focus on fuel cells. So each one is its own sort of thing. So when they went to make changes to investment tax credit, and you can see from the complexity here, they did kind of piecemeal. They pulled things together. So as you kind of expect, wind and solar did not do terribly well. That was part of the kind of some of the warnings we got on pretty early, is that wind and solar are basically going to be disallowed. So if, for example, you start your project after July 4th of 26, they said you have to have it done by the end of the year in 2027. So you get about a year and a half to do it. If your project is already working, you can still qualify for the investment tax credit. But then after that, you're not going to be able to qualify at all. So they sunset it pretty aggressively. Fuel cells were actually increased. So part of the current administration is they are really driving for particular things like geothermal energy, fuel cells, and nuclear were all part of the Inflation Reduction Act. Those were all continued and added to as part of the One Big Beautiful Bill. So fuel cells, if you're working on that, they're actually worth more through the investment tax credit. The other thing that changed, as you can imagine, is we're pushing for more build local support within the US. So there are content bonuses if you build entirely domestically. Now, those of you who are in the solar industry will realize most solar panels are not manufactured domestically, but things like geothermal heat pumps very much are, because you can source a lot of the steel in the US. So there is a real big advantage there if you are building things domestically. Now, the other thing is, and I'll go through a little bit on the next slide, but credit recapture for these foreign influenced entities. So the other thing that's included in a lot of the One Big Beautiful Bill is, depending on how you look at it, it's a bit of a poison pill for some things, but there are foreign entity rules where if you are a specified foreign entity or an influenced entity, you may not be eligible for parts of the Inflation Reduction Act anymore. The One Big Beautiful Bill eliminated that. There's also a list of prohibited foreign entities. So, for example, China and Russia, for instance, they can't own your geothermal heat pump facility or whatever else it may be. You will not be able to qualify for these credits at all. Now, those are an entire set of different rules. I'm not going to spend a lot of time on it, but you do need to be aware that the ownership structure is going to matter for a lot of these incentives. And very important that you don't misrepresent this. As Ben said before, the IRS is putting penalties on people misrepresenting themselves. So do not go and say it's not a foreign-owned entity if it actually is. But again, like I said, there is an entire webinar just on this. I'm not going to spend a huge amount of time, but I would recommend, if you're dealing with any of these energy technologies like wind, solar, geothermal, just come speak to us individually. There's a lot of individual pieces you need to understand. All right, I guess since I did the bad news, Will, how about you give us the good news?
Okay, sounds good. Thanks, Mark. So yeah, covered a lot on the energy efficiency side. We'll try to keep it pretty simple on the cost segregation side, because it is pretty simple news that is good news. So in the One Big Beautiful Bill, they brought back 100% bonus depreciation. So what does that mean? Well, we've had 100% bonus before, back in Trump's first term in his Tax Cuts and Jobs Act in 2017, and it extended through 2022, where it was supposed to phase out or phase down 20% till it went back to zero. So in the current state, 2023 went down to 80, 2024 60, and this year was expected to be at 40% bonus depreciation. But now that the One Big Beautiful Bill passed, we have brought back 100% bonus depreciation, and they have made it permanent for the time being. And this is for any property that was placed in service after January 19th, 2025. So it's basically this tax year moving forward. Any properties that you purchased in past years, 2023, 2024, will still get that lower bonus depreciation rate. But this is a big deal because we're able to take, when it comes to cost segregation, the dollar amount that we segregate from your total cost of a building, and you can take that full amount in the first year instead of the typical shorter class lives of 5, 7, 15 years. So on this next slide, we're going to look at an example. If we had a $1 million building, you can see I've got it split into three, or segregated into three different categories here. We'll pretend that we bought this building on July 1st, 2025, and we left and couldn't touch 700,000 of this property and left it in the 39-year class life where your commercial building will typically sit. And then we were able to segregate out 200,000 into land improvements, or a 15-year class life, and another 100,000 into 5-year personal property, giving us that total of $1 million. So under the previous bonus rate of 40%, you'd only be able to take 40% of those values that we were able to identify as a first-year deduction, and you would have to wait the remaining life to see the full benefit. So for the 15-year asset, at 40% depreciation, you can only take 80% or 80,000 of that 200,000, and then wait the other 14 years to depreciate the other 120,000. Whereas with 100% bonus, you get to take the full 200,000 the very first year. So you can see the two columns here. With 40% bonus depreciation, we're able to reclassify just 120,000 as a first year deduction. With 100% bonus depreciation, that increases to 300. You add in your straight line depreciation from the amount that we can't touch from the 700,000. It gives you a total first year deduction of $317,000. So pretty significant when it comes to your ROI just in the first year, seeing the return on your investment so soon, just from the tax standpoint. And if we go to the next slide, we can see how the actual tax savings come into play here. So assuming a 30% tax rate at 40% bonus with that deduction that we had identified, you would save $41,000 and $384 in tax savings, actual, tax that you would defer. Whereas with 100% bonus, that number more than doubles to 100,000 by being able to take that full 300,000 that we are able to segregate into shorter class lives. So as you can see, more than double the savings going from 40 to 100. This is a really big deal because if you purchased a property this year, you're able to get a significant portion of your investment back just from tax savings alone, without even thinking about the other plays in real estate with the cash flow, principal pay down, appreciation, all those things. So it gives you this money today to be able to reinvest into your business, to grow your business, buy more properties, instead of leaving this money locked up into your property for the next 30, 40 years, which, as you can imagine, it can be a supercharger in growing your portfolio by pulling that money out and continuing to reinvest it. So really big deal on the real estate side. We're all really excited about it. It makes things much more lucrative, even for lower basis properties, because you're getting that full amount first year. And so, big deal, makes things simpler, and we're happy to see it back.
Perfect. All right. Thanks, Will. Just a quick cheat sheet for those of you out there. If you listened to Will and missed a lot of what I said, and you want to know whether or not you or your client should do any of these energy efficiency incentives, just ask, are you doing cost segregation? And as you can see from Will's math on the board here, almost everyone's going to do it. So if you can take accelerated depreciation through cost segregation, you should at least investigate doing 179D 45L investment tax credits while you have the time. They run on the same tax mechanism. So just a quick pointer out there that if you see people are excited about 100% bonus cost seg, then let's add icing to your cake by trying to layer on a 179D here, get you a little bit more first year depreciation. And with that, we are actually at the end. I know we have time for some questions, and we had a few in the chat. I think, who's going to jump on the first one here? I think, Devin, you had one, right?
Yeah. So there's a question on the application of this to foreign-based U.S. businesses. So I'll assume this is meaning the R&D credit and or the capitalization requirements. Basically, so think about like if you're a software development firm, that's where we see it the most. The bill says if you're outsourcing that, where the R&D, the development work is taking place overseas, those costs still need to be capitalized. So that would be whether they're contractors or overseas based employees, essentially their wage or their payment from you, the company, can't be expensed right away, needs to be amortized over 15 years. And so that's, it's kind of black and white, the bill saying that. The intention is, like the credit was enacted in general decades ago, it's to incentivize US-based hiring, growth, cost incurrence, whatnot. So it's punishing companies outsourcing their development work. So like I said, it's mainly for software. You could think of it in terms of like a manufacturing client where all of the prototyping and testing, for example, is done overseas physically. That could be another example, but it comes down to reporting, compliance. It's definitely unfortunate, but upon an audit, they probably could substantiate that pretty quickly. You know, the idea that R&D was being done overseas. They could look at staff and contractor payments, personnel, their titles, maybe logs internally about what sort of work they were doing. So especially if you are claiming the credit, which is for US-based only costs, might as well do it fully right and capitalize those foreign-based ones, even if you don't get a credit on that.
I also saw there's a question. Ooh.
Sorry, I was just gonna follow up just in case the question was about application of foreign-owned properties for energy efficiency or cost segregation. That does come up periodically. Occasionally, we'll get a company that is German or Canadian or whatever, and they own a business in the U.S. Generally speaking, they are going to be set up as an LLC in the U.S. If they're not, then there's generally a treaty where you can't basically take a tax deduction in the U.S. Canada will take it back from you. So we've run into that a few times, or Germany, or where else it is. So generally, you need to have a U.S. LLC owning the building in order to be able to leverage any of these accelerated depreciations through cost seg 179D, 45L, or investment tax credits. So, quick answer.
Just another question as far as how does a company qualify for R&D? Essentially, the IRS has what's called a four-part test. Simple as that. It is just four separate parts that you have to answer yes to in order to qualify. First and foremost, it's just that there's a permitted purpose, and this is just saying that the activity you're performing is intended to create a new or improved business component. That business component can be a product, process, computer software, formula, or technique, and you're looking to improve its functionality, performance, reliability, quality. So something that's just new or improved to your business. Number two is technological in nature. That's just saying that the activity must be rooted in one of the hard sciences. So physical or biological sciences, computer science, engineering. It can't be rooted in the social sciences, arts, something like marketing or human, or any type of, sometimes chiropractic can get a little iffy with it sometimes. So really just related in the hard sciences. Third is going to be an elimination of uncertainty. And that's just saying that at the start of the project, you had something that you're uncertain about. If you're uncertain, if you could achieve that end goal, or really how to go about doing so in the best way. And so it's, it could be an uncertainty to your capability, your method, your design, whatever that might be. It's just there was an uncertainty that you had at the beginning of this at this project. And then lastly, you have a process of experimentation related to that uncertainty. In most cases, is just saying that because you had that uncertainty, you then engage in a process to evaluate alternatives, test your hypotheses, maybe model or simulate some results, and then ultimately refine your approach. In the end, it's not simply just having a known method, something that's already new or something that's already true to the industry and true to the world, and just taking that and implementing it in your own business, but really taking something and developing it yourself for some type of permitted purpose. So it's really simply put, if you just are able to say, is it new? Is it technical? Was there an uncertainty, and did you go through some experimentation? If you can answer yes to all those, most likely there's going to be some R&D activities and qualification there.
Great. Will, we got a question for you. From David, are the rules for cost segregation different if you're doing leasehold?
Great question. So the rules aren't really different. Actually, leasehold improvements actually have an added benefit that your typical new construction or acquisition wouldn't have. And we've actually done a whole separate webinar on that, and it's called Qualified Improvement Property, or QIP. But basically, going back to the question, with leasehold improvements, just like an acquisition, if you complete your leasehold improvements this year in 2025, you'll get that 100% bonus, just like you would if you were to purchase a building. So it does get a little trickier if you have, with new construction, started that construction before this year and finished it this year, that's something we'd want to look at as far as how much of the work was done prior to that January 19th date of 2025. Before the rule change for 100% bonus. But if you start your improvements this year, finish them this year, you'll get that 100% bonus just like you would if you were to purchase a new property.
And we got one on AI, specifically any added incentives specifically for AI research. I would say for one, we do have a whole grants funding and incentives team. So as far as federal or state or municipal grants that are specifically in that area, that could be. Ben and I are on the financial end. We do have a whole grants technical team where we're happy to perform kind of a search service where we can do up to 10 hours, 20, 30, identifying every single grant based on your company's work that they could be eligible for. And then phase 2, we can also help you apply to specific ones. So that's one. As far as the R&D credit, yeah, I think companies using AI, it could often be indicative of research and development being done, especially in the software space. I would just say that if you're a company using readily off the shelf AI to essentially perform the research you want to perform, not only is the process of experimentation criteria going to be hard to meet, but there's also really not going to be anything to quantify as far as calculating the credit. Typically we're looking at labor hours, man hours, supplies and materials consumed. So if you're using AI to help you come up with a solution, that's great, but nothing really to look at for the credit. If you're using it to help facilitate, plus you're doing your own programming, development, coming up with something new and novel, and the AI is just kind of helping in that regard, then definitely that would be a stronger case.
I also see one related to restaurants and seasonal menus, and I would say that most likely I would say no, doesn't qualify. Of course, you can get into some nuances that we could look into with you specifically on that, but even though you might have some type of elimination of uncertainty or process of experimentation, it likely wouldn't qualify the permitted purpose or technological in nature tests. Again, just because the business component has to look to improve function, performance, reliability, and be rooted in one of the hard sciences. Creating a new seasonal menu likely wouldn't fall under either of those categories. So most likely would not qualify.
Yeah, so we get a lot of clients specifically in like more beverage, but food and beverage, it's really product development. Say like a brewery is coming up with an actual new formulation where they needed to test the ABV and the whatever else in technical terms, but they were actually developing something new, versus it's kind of like the AI thing. If you're throwing a bunch of ingredients together to create a new menu item, not really developing developing a new food, I'm sure sounds kind of dumb, but it's easier to think of in the beverage space. It needs to be that little bit of extra actual rooted in the hard sciences and process of experimentation to arrive. Something new is great. Something improved is also great, but it doesn't seem like that would quite meet it.
All right. I think that handled most of the questions that we had in the chat. If anyone has any last minute questions, you can definitely ask them now. We weren't sure if this was going to take the full hour, just for full transparency, but we did it 45 minutes before and we were jam packed. So we wanted to make sure we had another session here to make sure we could handle all the questions. If you do have any other questions, the team dropped a scheduling link into the chat. You can feel free to use that. You'll get with one of us and we'll kind of chat through any specific questions you had. And otherwise, I think you should have pretty couple easy ways to find us. You can go find us on LinkedIn, find us on our website. You could find a replay of this webinar if you have any other questions. But otherwise, I don't see anything else in the chat, so I think we'll let everyone out early. All right. Well, thanks everyone for the time. I appreciate it, and enjoy the rest of your day.
Thanks, everyone.
Thanks. Guys, have a good one.